Okay, welcome back. We have talked about the gross profit margin and the net profit margin. The next margin we're moving on to talk about is what's referred to as the return on capital employed. I almost feel like I've been going on about this one. I think this is probably one of your better margins because it's all about return on capital employed. When an investor looks at a business, they think, if I put my money inside, how much am I going to get back out on top of what I invest? So you put, like, for example, £100 in the bank, and the bank tells you we give you 5% interest. You look at your bank account, you leave that £100 in there for the year, you look in your bank account, they'll give you 5% interest, which is, of course, £5. You look in your bank account at the end of the year, you will see £105. Your return has been £5. The capital employed, if you like the money invested, has been £100. So I guess it's normal to think that you would always want a higher return on capital employed. And I guess when I say the return, ultimately we're talking about the net profit. Because the bank takes the money, that you do, they invest it, they pay off their expenses, and whatever's left, if you like, is what they give you as a share of that profit. Technically you're calling that interest, but really it's a share of bank profits at the end, or what they expect their profits to be, or what they intend to give you. And so the argument really is that what we're really saying here is, how well has that person taken that money to generate, if you like, a return for you? And that's pretty much what it is. So the higher the number, if you like, the bigger. But I guess the argument is, as we look later on, that we could have some strange. Let's look at it. Let's just compare both businesses. Let's just do the comparisons first of all, and which is why, again, this whole thing is so important. So if we look here, what is going on here? Oh. Okay, here we are. So let us see. So you can see this. You can see what's going on over here. I mentioned this earlier on. Mr. A invests £2,000. He gets sales of 1,000. So the argument, the correlation somehow is that if I had given him £10,000, which is 5 times this, he technically would have given me 5 times worth of sales. I mean, give or take. It's not a fact. But the argument is that, and that's why we're looking at this in terms of percentages, as opposed to just looking at these figures here. So these figures are so false. There's very little information here, actually. It's really about how much are you able to make on what we have given you. And you can obviously see that Mr. A has done much better, because Mr. A was given £2,000 and he's brought you back £100 in that period. Mr. B was given £10,000 and he's made 150. So what I can do is I can, yes, find the what the return on capital employed is, and in this scenario I have 1 over 20. So you have a half times 10. So you have 5% here, and in this scenario you almost have I'm just saying it's more than that very quickly. So that's 150 divided by 10,000. So this is 1.5%. So you can see the argument here is that business A has brought you a higher return on capital employed. Yes. So yeah, I think that's the return on capital employed. Again, you can see that I'm just extending this argument just because I have some time. We don't understand. We don't know what's happened here. Maybe Mr. Company B has just recently bought some new assets. So it's going to take some time to actually generate this income. Because the whole point of capital is, if you remember, A is equal to C plus L. C comes in, no problem. But maybe C was bought just towards the end of the year. So C has come in, and so of course A has also gone up. But these assets need time to generate the actual income or profits we're looking for. So even though this looks better than this one, it means that the key point is that we should always be cautious even though the number is low, it might be because we just need some more time for the assets or the money that's been received to then buy the assets that will then generate this net profit. So maybe we just need to give Mr. B some more time. But hopefully we'll see that over the coming years in Mr. Beast's profits, to see these increase, over time. So that's return on capital employed. So the argument is, what we're saying is, for every £100 invested, how much are you keeping? How much is being returned to you? How much is it generating, if you like? How much is being returned to you? And how much is it generating? Okay, great stuff. So that brings us to the end of our profitability ratios. What we're going to do next is move into our liquidity ratios. Great stuff. I'll see you then.